Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Quick look at Uber today. Wanted to take a look at their earnings. Stock is down 5% right at market open after their Q4 earnings release. And the earnings seem okay. Maybe it's the guidance that's driving the stock down. Maybe it's worries about deaccelerating revenue growth. However, this is still a stock that has an interesting valuation, generating almost $7 billion in free cash flow in fiscal year 24 against a $140 billion market cap. You're talking about a 5%-ish free cash flow yield on a stock that just grew at about 20% in the last year. That's pretty interesting in this type of market. What's keeping it down? We'll take a look at that in a second. In the last year, the stock is down 4% or so, trading not too far away from 52-week lows. So it'll be interesting to see if the valuation makes sense and what the earnings actually look like. Earnings high level look pretty good. Gross bookings up about 18%, revenue up 20%. There is going to be a currency impact here. This is a business that has 50% of their revenue come from international markets. And when the USD, the US dollar, is strong against those currencies, that's going to have a negative impact on their overall potential growth if the growth is coming from those international markets. Looking at their net income, you sort of have to ignore this. There's a $6.4 billion benefit from a tax valuation release, so some sort of tax credit. So when you look at year over year EPS numbers, they're going to be really impacted by that $6.4 billion number. On top of that, this is a business that has equity investments in various businesses, 10 to 20% ownership in Grab, Didi, Aurora, a few other businesses. They made agreements with those companies for one reason or another. Usually, in the case of companies like Grab and Didi, it was like, hey, we're not going to compete in your market. We're going to sort of close up shop and sell you our operations. But in order for us to do that, or because we're doing that, we're going to take, 10 to 20% equity ownership in your businesses. And that could be an interesting little additive thing you get as a shareholder of Uber, because companies like Grab are pretty interesting in their own, and those are publicly traded companies, so you can see how those are doing as well. They do generate a ton of free cash flow when you look at this business. Adjusted EBITDA does sort of convert into free cash flow pretty readily here. They do have a captive insurance business. In the past, that business has had relatively strict reserves. They've released some of that reserving on a go-forward basis, so EBITDA to cash conversion should be more closely aligned on a go-forward basis. They said something like 90% plus, and this quarter was basically 100% of EBITDA converted to free cash flow. That's nice. Not a ton of capex on a business like this one. There's certainly some, but it's not a hugely capital intensive business. It's relatively asset light right now, and that leads to pretty good free cash flow, and that leads to a pretty good balance sheet. They have about $7 billion in cash, short-term investments, etc., against maybe $7 to $8 billion in debt. So the balance sheet is pretty solid overall. Q4 really solid, full year 24 really solid. Q1 is where it gets a bit murky. Gross bookings growth of 17% to 21% is a bit lower than the market expected. You're essentially translating that to 42 to 43.5 billion in gross bookings, and the 17 to 21% number is on a constant currency basis, and they're expecting anywhere from 4 to 7% currency headwinds depending on the business line, 5.5% overall. So that means that there's a pretty significant currency headwind expected in Q1 2025 due to the strengthening dollar. Whether or not that continues throughout the whole year depends to be seen, but this is impacting how the market's going to look at this. The market was expecting closer to 43.5 billion for Q1, and now that's on the top end of their guidance. So you're anywhere from 12 to 16% growth on the revenue side on a regular basis without adjusting for this constant currency nonsense, versus the market expecting that to be closer to 16%. So on the top end, you're still going to hit that, but the guidance is now a bit light. Adjusted EBITDA is sort of following the same thing, maybe slightly light, but the margins are still solid. You're seeing, mid-teens revenue growth, but 30 to 37% EBITDA growth. So that shows margin expansion. That's really where the business has been doing well lately. Revenue growth has been solid, but margin expansion has been solid. When you look at their investor day from last year, their 24 through 26 guidance was, hey, we're going to have gross bookings in the mid-teens range from 24 through 26. They are achieving that. And then EBITDA growth is going to be anywhere from 30 to 40% on a go-forward basis annually. And in 2024, they hit something like 60% adjusted EBITDA growth, and then for 25 they're probably going to guide closer to that lower end of that 30 to 40% range, depending based on how they're guiding for Q1. One thing to note too is that you are seeing a deacceleration here. You're seeing a deacceleration from 18% growth in gross bookings in 24 down to maybe 11 to 15% growth when you adjust for that currency headwind. So that isn't going to be loved by the market. You're seeing a deacceleration in EBITDA growth from 60% down into the 30 to 37% range. That's just for Q1. Maybe it'll deaccelerate more. So that's why the market is reacting as negatively as it is. The market doesn't love deacceleration, especially when it expected something higher. So if the market was going in expecting 15 to 16% growth on the top end, and now they're seeing 12 to 16% growth, that the worry that it's going to be below 15 is certainly there, and that's what's impacting the stock price and driving it lower. And it's not just that, it's also the idea that this is a business that's very dependent on mobility, it's very dependent on delivery. As far as their revenue goes, you can see that mobility makes up, maybe 60% of their revenue, and mobility is the business that might be largely impacted by autonomous vehicles. You've already got companies like Waymo testing in various cities, and still that is a very, very, very small portion of overall rides that are taken in the United States and or worldwide. But the worry is always going to be there. How is that business going to impact a company like Uber when autonomous vehicle become more common? Will Uber benefit from that, or will they be harmed by that? And I think right now the market is certainly leaning towards the idea that the Uber is going to be harmed by that. So it's interesting to sort of look at that and see what that means for Uber as a whole and whether that threat is real. It seems like Uber is pretty aware that autonomous vehicles are a threat in the future. The question is, how soon are they going to be a threat, and what does it mean for a business like Uber? Because it could also be a benefit. They show this graph over here that as the cost of driving a vehicle in the city per mile goes down, the number of people and the percentage of miles that are going to be driven in the city is going to go up. And if they can reduce the cost of driving that vehicle per mile in the city through something, they can really benefit from this. And that something could be making their business more efficient, or autonomous vehicle and less dependence on their current supply cycle, less dependence on having to pay somebody. Right now, Uber is very much a demand supply cycle. Uber is the demand aggregator. The drivers that work under the Uber app are the supply. In the future, those drivers could potentially be replaced by autonomous vehicle, and that could be a problem if that supply is suddenly offered through a variety of other individual apps. So Uber partners with Waymo, with Aurora, with AV Ride, with a bunch of these companies. They have other potential players that they're not currently partnered with. But in the future, if you have to go to Waymo or you have to go to a Tesla app to get a ride, an autonomous vehicle ride, that obviously hurts Uber. However, if they can partner with these guys and basically do what they do now, but work as a demand aggregator for these various autonomous vehicle providers, then maybe, just maybe, this business can be even better than what it is today, because their revenue might not be impacted that much, their gross bookings might not be impacted that much, but they can reduce the cost per mile by working with more efficient autonomous vehicle tech, and now have a higher addressable market. That's really the idea you'd be investing in as an Uber investor in the long term, because they do know that autonomous vehicles are a thing already, but they're not fully commercialized yet, and some challenges remain. First, you need this, super consistent human safety record. Some of that is there already. Waymo's doing a lot of testing, but they're not doing a huge amount of testing, and that's why they're expanding into more cities, testing in more environments. You look at something like Cruise, the GM owned autonomous vehicle company. They had an accident in San Francisco. I believe they unfortunately killed somebody, ran a person over, had to stop testing. And now, a year or so later, they're basically shutting down Cruise. They've invested $10 billion into that and now are saying, we're not going to do it anymore because there's a lot that goes into maintaining testing and making sure it's safe, making sure it's efficient. And once that's done on a larger scale, which we're probably not there yet, you have to have regulations that enable more commercialization, more expansion. And once that happens, the supply has to grow to meet that demand that exists right now. And you've got to have scalable on the ground operations. Right now Waymo exists in a variety of cities and is expanding into more cities. Austin, for example, with a partnership with Uber, but also in other cities on their own. And they're sort of testing as to how to best go about this. If they put the on the ground operations with Uber and sort of Uber manages that fleet, maybe it's better for them than them having to manage their own fleet. And one has to remember that the number of rides that are provided by Waymo right now are a fraction of a fraction of a fraction of the number of rides that are provided by the supply that exists with Uber. And even once they launch in Austin under the Uber platform, the Waymo rides are going to be a very small percentage of the number of rides that are provided by Uber as a whole. And this is just in the United States. What happens once you launch internationally? The scale of these on the ground operations has to be huge to manage the demand that's going to exist. And you also need a high utilization network so you can manage the variable demand and supply that exists out there, because the number of rides that are needed on a Friday afternoon at 7 p.m. are a lot different than the number of rides that are needed on a Tuesday at 2 a.m. That's huge variability, and you need a huge amount of supply to manage it, but also to manage it efficiently. But you also need to find the demand that exists for that supply. If Waymo and Tesla and a bunch of other companies suddenly make their own apps, then that supply kind of gets fragmented across a variety of other apps. If they provide their rides on a high utilization network like Uber's, that supply is paired with the most demand that's out there. That's really what Uber brings to the table. They're a demand aggregator for this new wave of supply, this different wave of supply that's going to exist in the future, and that's going to be Uber's strength. And as an investor in Uber, that's sort of what you have to believe in, because you can kind of see the variability that exists. You can see whether that variability is the same in different cities, different months, different climates. And also, you have to see whether autonomy is there yet. If you're investing in Uber, you're probably not worried that Uber is going to be replaced tomorrow, because the reality is that Uber human-driven miles right now cost about $2 per mile that's driven. And in the future, with autonomous vehicle, that number might come down and make it more attractive to consumers. But you have to compare that against autonomous vehicles. Those right now still cost a bunch more. They're not quite there yet. There's the hardware platform that you have to build out, the AV operating costs, insurance, compute, maintenance, cleaning. There's potentially going to have to be a remote operator depending on how it's designed. You have to manage the fleet. You have to park it somewhere. You have to insure it. You have to staff it. You have to buy real estate to do that. You have to generate demand. Uber's already doing that, but in the Waymo app, they have to do marketing, incentives, payments, customer support, other technology. There's other fixed costs for the company that Uber already has. So when you look at the autonomous vehicles on their own, are they going to be better off by partnering with something like Uber, by partnering with a demand aggregator? That's sort of how you have to think about this. So as you think about, well, where is this company going to be a year or 2 or 3 from now? Probably the same spot it is today. What about 5 to 10 years from now, where autonomous vehicles are legally on the roads, the supply is a lot higher? What does the world look like then? And that's really where the question marks come into play around Uber. And I think when I look at it, I still see Uber as a potential winner in this expansion, because they'll be able to get supply at a lower cost and remain a demand aggregator as they are today, because they're only going to grow. More and more people are going to use Uber, get on the Uber app, and they've got a lot of stuff going on there that is improving the business. It's not just It's not just mobility. It's not just delivery. It's a bunch of other stuff. Now there's an advertising business they're growing. Mobility is expanding into other areas. They have that freight business. And it's an interesting thing because anytime you get, tens and tens of millions of people onto an app, you can do other stuff within that app and improve your margins, improve your revenue. And right now, the market isn't looking at that as much as they are looking at the fact that, hey, autonomy is going to kill this business. Autonomous vehicles are going to kill this business. And if there's one winner in the autonomous vehicle world, then yeah, this business is probably screwed. But if there's a ton of them and autonomous vehicles are being provided by multiple brands and multiple car makers, and they're all looking for a partner to help fill the demand that exists for the supply that's now on the roads, Uber is going to be right there. If Tesla wins it all or Waymo wins it all, then they can have their own app and Uber's screwed. But if there's many winners, then Uber could really benefit from that. So that's my take on it. Let me know what you think. But let's take a quick look at the valuation before we finish the video. Okay, so valuation disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. We've got a $136 billion market cap business, good balance sheet. On a 24 actual basis, you've got a 5% free cash flow yield with near $7 billion in free cash flow generated in 24. This company is implementing a share buyback program. You saw some of that in 24 already, but keep in mind, they do have $1 to $2 billion in stock-based compensation every single year. So as we look at the buyback here, I'm going to offset that with the stock-based compensation. If you want to play around with these numbers, hit file, make a copy. The link to the spreadsheet will be down below. I've got actuals in for 24, then for 25, 13% revenue growth with some margin improvement, then slowing growth down to 28. You've got margins improving by 30 basis points a year or so, which on the margin side may be conservative. On the revenue side, with some of the deacceleration in growth due to the currency impact, maybe some concerns there, but I feel okay about this. Got 50% of the cash going towards buybacks, offset by stock-based compensation. Still leaves about $22 billion in excess free cash flow, so they can certainly buy back more shares, and they probably will, but I want to be conservative here. They have the opportunity to make acquisitions, to make investments in the business, to do whatever. And then from a valuation perspective, I think 5% seems pretty fair. There's going to be some buyback, but the generation is there. This is a business that's growing at a pretty good clip. To get a 5% free cash flow yield business that's growing in the mid-teens is pretty unheard of in this market. So seems pretty fair to give that valuation a couple of years from now if margins improve and it's still growing. There's obviously the risk of autonomous vehicles, but like I said, are those overstated? Will Uber potentially benefit? I think they can. If I'm an investor, I have to make peace with the idea that they're going to be a demand aggregator. Right now, the supply are people driving cars. In the future is going to be autonomous vehicles driving cars. As long as that supply with the autonomous vehicle area isn't just one car maker, one car company, then Uber will certainly still be around, will certainly still act as a demand aggregator because it's got tens of millions and hundreds of millions even people looking at its app. It's got the potential to expand their services from mobility to delivery to other stuff. They've already started adding things like rental cars within the Uber app. They've added advertising when you look at their delivery pages. So there's other adjacent businesses that they're moving into that are going to improve their revenue, improve their margins for sure, and eventually help this become a better business in the near term. And in the longer term, the threat of autonomous vehicles might be a little bit overstated in my mind. So I feel pretty comfortable with this assumption that, hey, this is still going to be a business 5 to 10 years from now. It's just going to be different. It's going to be different supply. And if that supply is cheaper and Uber is still a demand aggregator, the number of people they can reach, the number of people that are going to use Uber might actually go up. If Uber is suddenly 25% cheaper, are you going to be more likely to use it? Sure. And if their margins are better, despite the fact that their fares are 25% cheaper, is the stock price going to benefit? Probably. That's kind of how you have to look at it. So from a valuation perspective at a 5% yield, I've got an 11.8% expected return here. You can kind of look at the various yields you can place to the stock, anywhere from a 7% yield, which gets you a 5% return, down to a 3% free cash flow yield, which gets you a 23% return. So this is a, $73 to $183 stock, depending on your free cash flow yield assumptions that you're making. So with a 10% target return, I get a fair value of $70. With a 15% target return, I get a fair value of $56. Am I a buyer here? I'm close to thinking about it. I think because of the unknowns around autonomous vehicles, sure, I've sort of talked about how it makes sense to me that the demand platform will still survive. The only risk exists is if there's one or two winners in the autonomous vehicle space, and those are the only two guys providing autonomous vehicles, then Uber is kind of in trouble because those guys can sort of develop their own apps and drive demand there, and Uber is screwed in that scenario. So maybe, just maybe, you want some margin of safety there, which gets you into that like high 50s, low 60s range, which is where it's trading at today. So to me, this seems like a very interesting buy. I'll probably consider it, especially if it drops a bit more. If it's in the low 60s, will I start a position? I think so. I actually owned Uber in the past, sold out of it pretty quickly because it wasn't really doing anything. I do want to see some stocks that have momentum in my portfolio, and sometimes if they're not really doing anything and there's question marks around their future growth, I get a bit concerned. So maybe this is one of those. So I'll have to keep a closer eye on it. Maybe take a look at another series of earnings, see what Q1 looks like before I start a position. But in the long term, from a valuation perspective, it certainly looks interesting to me. So what do you think? Am I wrong on anything? Am I wrong on my take on autonomous vehicles? Am I off in any way? Leave a comment down below. Otherwise, like, subscribe, all of that good stuff. And thank you for watching. Bye.